I am now announcing a comprehensive review of the Income Tax Act 1961. Short-term gains on certain financial assets shall henceforth attract a tax rate of 20%. I propose to abolish the so-called angel tax for all classes of investors for the new tax regime. First, the standard deduction for salaried employees is proposed to be increased from 50,000 to 75,000 rupees.
The budget of July 2024 will be remembered for the mega tax changes that the Modi government set in motion as it embarked on its third term. The rationalization of the capital gains tax regime did happen, but along with an increase in the tax rates. The common man did get some relief, but only in the new default income tax regime. The controversial angel tax was abolished and taxation of buybacks was streamlined. So what will Finance Minister Nirmala Sitharaman have in store for taxpayers and the country in Budget 2025? Hello and welcome to the Budget Countdown. I am your host Surabhi Upadhyay, and over the next half hour, I'll have with me a panel of experts to discuss the broad contours, the broad expectations that we have from this year's budget. Well, to start off with, an update on the review of the Income Tax Act itself is widely anticipated. This is something that the Finance Minister had announced in the July budget with a 6-month timeline. Now, while the review of the IT Act is not expected to really usher in any major changes in the tax rates per se, the exercise is expected to remove redundancies in the 1961 Act, making the language perhaps more simpler and concise. Now, let me quickly list out 5 major expectations from this budget. First, spurring consumption. While the noise around the economic slowdown is getting very loud, experts don't expect any major reduction in personal income tax rates, and the sweeteners, if at all, would probably be only in the new default tax regime. Of course, the usual asks around higher reductions for home loans, as well as the health insurance piece, the premiums there, and the popular Section 80C, all of those continue. Now coming to the second major expectation, spurring manufacturing. Tax experts say that this can be done by bringing back the concessional 15% rate of income tax for new manufacturing companies, and also perhaps offering more incentives and deductions for R&D, as well as new plant and machinery capex, which is undertaken by manufacturing firms. There is also a suggestion of reducing the tax rate for MSMEs and perhaps for smaller companies from the prevailing rates of nearly 25%. Expectation number 3, attracting investments. The financial world is hoping that tax exemptions that are enjoyed by sovereign wealth funds and pension funds that are investing in the Indian infrastructure sector, that they will be perhaps extended. The market also awaits more investment-friendly measures that can transform GIFT City into a truly thriving international financial hub. Request number 4 is on capital gains tax. Now, given the IPO frenzy in the market, some sections are urging the finance minister to make the capital gains tax regime more favorable for companies that are heading for listing by reducing the holding period definition for long-term from 2 years to 1 year. The mutual fund industry, by the way, is of course hoping that some tax benefits are restored to debt mutual funds as well. The 5th and the final expectation is reducing tax litigation. The tax world is hoping that after the capital gains tax regime, the FM now moves to streamline and simplify the withholding tax regime by reducing the number of TDS rates to just say 3 or 4 major rates. Industry is also hoping that the FM makes the safe harbor rules more attractive and widely applicable to reduce tax litigation. So there you have it, a broad framework of what the big asks are across the industry. Let me now welcome in our panel of experts to give us some more insights into all of this. Sameer Gupta, National Tax Leader at EY, is joining in. Sameer, so good to have you with us in the studios. Thanks for coming in. We also have with us Bijal Ajinkya, Senior Partner at Khaitan and Company. Bijal, welcome to the show. Thanks for joining in. And we have with us Sunil Badala, Head of Tax at KPMG India. Thank you so much, ladies and gentlemen, for joining in.
Thank
you. That's
you.
an exhaustive kind of a primer that I had to put out there for our viewers. But I want to get your big picture assumption first. If you look at this budget, what will the headline be, Sameer?
No, look, I think that, as you've seen even in the past, the government has been working on a sustained economic development program, right? So you have your investment-driven growth regime, you have, a lot happening on fiscal consolidation. I think the big thing will be around tax simplification. And I think they're going to continue down that journey. So 2 points from my perspective. One, our tax GDP ratio is still at 18.1, center plus state. And, we are already moving up the ranks in terms of growth in terms of economies. So if we really want to be a large economy and be in the top 3, we need to get where everyone else is, which is 30% plus. So a moderate tax policy regime with minimization of litigation. I think those would be the 2 big imperatives of the government going forward.
Okay, directionally that could be sort of...
I think so. I think that's where it will be.
The big sort of move to undertake. Bijal, what do you think the headline is going to be? Evening 1st of February. Tax headline.
So I think further rationalization and simplification of the tax laws, as well as a new regime vis-a-vis litigation, because the amount of litigation and the pending litigation itself really requires a lot more of, streamlining and a real boost to both manufacturing sector as well as to just infrastructure.
We want it all, don't we? Lesser litigation, boost manufacturing, boost the economy. Got it. Sunil, headline for you.
So agreeing with, Sameer and Bijal, I think there'll be minimum changes in this budget, given that obviously there'll be mention of the overall simplification of the new tax code. And in light of that, I think there will be just bare minimum changes.
Okay. Actually, let's start right there. This announcement that was made in July of reviewing the Income Tax Act itself. What is the need, Sameer, and can there be some changes in the rates as part of the simplification? What are you watching out for?
Look, I think that if you just step back, right, to maybe 2017-18 era, right, as we know, there was a new direct tax code on the anvils. There was a committee set up, the work happened, and a report was submitted. Now, what we've seen progressively, some elements of that has already been brought in, like the whole deemed dividend taxation move from company to shareholder.
Yes.
Many of those things were, encapsulated in that code. So a lot of the big things, I think, have been picked up probably from there. And therefore, the current situation is that the current act continues, but we still need to deal with a lot of, legacy matters which are there in that, which is where the FM said last time that, okay, if we're staying with the act, then let's look at simplification in terms of, reducing litigation, reducing compliance, and taking out redundant provisions and simplifying the language.
Sure.
So there's a lot of things over there that they can really do. For instance, capital gains, right?
Yeah.
They've touched it last year and they brought in a lot of reform. Maybe they come up with a new chapter on that, which is a simple chapter to read with. Now, that's a lot to ask for, but if you say from a wish list point of view, we should be getting to that kind of an outcome eventually.
Basically codified in the act itself, so it's very clear, simple, and sort of concise.
Exactly, because those were the stated objectives even when the earlier committee was set up.
Sure.
So elements of those could come in, and then there are redundant sections like there are some sections which talk about royalty, referencing back to the industrial policy era. So those are just lying around in the Direct Tax Act. So I think if those can be done away with, we can definitely have a more concise and user-friendly act.
Bijal, you mentioned reducing tax litigation, and I think this is a number that I picked up, Sameer, from your team, the notes that your team put together, that I think in FY24, it's stuck in my head, 31 lakh crore rupees stuck in litigation.
Almost 9.5% of India's GDP.
Unbelievable. Almost 9.5% of India's GDP stuck in litigation in courts of appeals here and there. So, Bijal, what could be the recipe? I mean, I remember in July, there was this Vivad Se Vishwas scheme announced for 2024. I don't know, if is it really, a big starting point or not? Or what else needs to be done to just reduce litigation?
So I would say one definitely is having more of a machinery, amongst just, income tax officers, Commissioner of Income Tax Appeals, etc. Increasing the number of benches hearing that. So I would say it's just really having more manpower at that level. And of course, perhaps having a system wherein at the Tribunal, High Court, Supreme Court, there is a timeline within which, from filing to hearing, there is a conclusion within a particular period of time. And perhaps that's something which should be done. We did have something in the Authority for Advanced Ruling when we did have it. At that point in time, there was a 6-month period from which the advanced ruling had to actually be provided. So perhaps some sort of a timeline does need to be set in so that there is much more clarity and certainty.
See, Bijal represents a legal firm, and even she's arguing for lesser litigation because probably there's so much work, right, with so many cases stuck at various tribunals here and there.
Sorry, but just to supplement what you said, Bijal. So I think if you look at our number of appeals that are pending, the maximum appeals which are currently pending is with the Commissioner Appeals, right? So out of 6 lakhs odd, 5 lakh plus appeals are pending with the Commissioner Appeals. So, just like you mentioned, there is a time frame within which Authority for Advanced Ruling has to hand out the decision. There has to be some time frame for the Commissioner Appeals as well.
Right. So it should be made time-bound basically to quickly dispose of the cases. Got that point. Okay, gentlemen, now let's start going step by step in terms of the bigger asks, right? And I'm going to break this down into the big ask, let's say, for consumer, for consumption, for manufacturing, and so on and so forth, and of course, financial services. For consumers, Sunil, there's this crying, sort of debate around a slowdown in the country. So therefore, I think the expectations are running high. In fact, we'll just put up some of the, the graphics that our team is picking up. Our, Delhi colleagues are saying that there could be some tweaks on the personal income tax front. But yes, it will probably be limited only to the new tax regime. What would your prescription be? If demand has to be given a boost, how can it be done through tax policy?
So I agree. I think the changes will be only in the new regime because obviously the government's intention is very clear that they do want to phase out the old regime. But in order to boost the consumption, I think the simplest thing that you can do is obviously give more money in the hands of the taxpayers, and you can do it two ways. One is, of course, increase the basic exemption limit, or
which was already done in the July budget. The sweeteners were there in July, so you expect 6 months later
but
they'll again do it?
You can do more.
Okay.
I'm just saying that that's one way of doing it.
Sure.
I kind of, in my mind at least, thinking that government may not go down that path simply because it will reduce the tax base, because the government intention is always to widen the tax base, right? So they may probably not change the basic exemption limit, but I think they can definitely look at giving more tax rebate. So right now the tax rebate is 25,000 rupees, which ensures that if you have an income up to 7 lakh rupees, you don't pay any tax. Now that might go to, let's say, 35 or 45,000, which actually gives you an opportunity to not pay tax up to 8 lakhs or 9 lakhs rupees of your income. Plus, I think there will be some tweaking in the slab rates. So let's say, currently you have 20% applicable up to 15 lakh rupees, and
this is all in the new regime. In the new regime.
Under the new regime. I don't think there will be any changes.
Anything in the old regime. So we can just, I'll still ask for those who are in the old regime. And there's a large community out there, people who do have home loans and they want to be in the old regime because you have that 24D where you get, the reduction on the interest, and part of ATC, whatever you get some reduction on the principal. Is there any hope, Sameer, for the rest of us?
Look, I'll go back to the principles. I think, like I said, moderate tax policy is one of the stated objectives of the government. So now that they've pivoted towards a concessional tax regime, they genuinely want everyone to, align to that. So I think all the focus is going to be that on that, Surabhi, really.
So maybe hike the, like he's saying, one is that you can hike the rebate, maybe the deduction.
Maybe, so the deduction, and then you could also, like standard deduction is there, they did increase it, so, that can go up a bit more. But I think there are some more ticklish issues, if I may just mention, that, for instance, one, there is this whole thing about interest on PF, on the employee contributions. Anything above 2.5 lakhs, there is a TDS on accrual, even though you're not withdrawing the interest or your balance. So that should definitely move to whenever you withdraw. So that is one thing. And ESOPs is a big thing, right? Today, as you know, the way the law is written, that there is a TDS that arises at the time when you are exercising your options, even though you may not be selling the shares. So it's like a dry tax. And you may be selling a couple of years down the line when more value is created. So why should you be paying the tax at that point in time?
But you've not sold the shares.
You've not sold the shares. So you may accrue the TDS, but collect it at a later stage when you sell. I think some of those things can definitely be a very good outcome. To benefit everyone.
Fair. So that's on the broader sort of consumption boost. Bijal, anything you'd like to add to this? Anything else to boost consumption? That's the first ask.
Yeah, I would agree with Sunil that, increasing the base exemption, from the 7 lakhs will actually definitely be a big boost. Perhaps at that level, we can also look at having, some higher deduction for FD interest rates. Because, that's where really you're looking at the masses actually, investing. So, that's something which they could perhaps do.
Which is stuck at, I think, 10,000 rupees, right? That's the only, that's the reduction you get.
Absolutely.
That's about it.
And perhaps some of the rebates which are otherwise available. One is, of course, PPF. The other could be like on insurance premium. That's something which is really looking out for.
Absolutely. So let's see if the common man indeed gets some sort of a further breather in Budget 2025. Now let's talk about corporate India and manufacturing, which is very, very clearly a huge push for the Modi government. Always has been through all the terms, including, of course, the third one. Now here, our colleagues are again picking up, Tim C from Delhi is picking up, that perhaps the scheme for new manufacturing companies, which was offering a concessional tax rate of 15%, perhaps that scheme could be brought back, but with a higher rate of tax. Instead of 15, maybe the tax rate goes up to 18%. That's sort of the chatter out there at this point in time. So I want to ask you, Sameer, apart from this, I mean, first of all, how successful was this scheme for new manufacturing companies? And aside of bringing this back, is there anything else that could be done?
No, I would say that, look, it was partly successful. I won't say that, everyone was, getting out, capex out over there. I think it was applicable in certain situations. And of course, people did take benefit of it. The only thing I would say is that if you look again at the macro picture, perhaps given where the rupee is headed and, to boost investments into India, long-term investments, if you're trying to start tinkering around with, getting more foreign investments, this can be a very nice package along with that.
Sure.
So you have PLI on one side, which is anyway being given very nuanced to sectors for resilient India. But then along with that, a concessional tax rate, if I may put it that way, for manufacturing can definitely help us. But the only thing I would add is that, and this debate is out there as to, why only manufacturing, why not for services and trading also.
Yeah.
If you look at the way the GDP is panning out, right? We need to bring manufacturing up, but really it's services and trading that's really holding it up.
Yeah.
So, why not give them also a booster? I mean, this is definitely going to be as an ask.
That could be a thought, absolutely. Why only manufacturing? Why not services as well? So, real quick, 30 seconds before we take a break on this.
So, okay, I would say in addition to what, Sameer mentioned, obviously this concessional rate is applicable only for the new manufacturing companies, right? Correct. Why not, broaden the impact and also allow, let's say, some kind of an investment allowance deduction that we used to have, decades ago, where let's say if you buy, a new plant and machinery for, say, 100 crores or, in excess of that, you get a deduction of 15% over and above the depreciation.
Well, this is great. So basically, really spur private capex. We keep crying saying the private capex cycle is not picking up. Incentivize people to set up newer plants and machinery, right?
Absolutely. So you don't have to set up a new manufacturing facility, but just expand.
Just capex. If you're even expanding and investing in plant and machinery, there could be some tax deductions. Let's see. It's a thought. We do have to take a very quick break, but we come back on the other side. What do the markets want? The financial markets from Budget 2025, is it all done with the capital gains tax changes in July, or is there more coming? We discuss this after the break. Welcome back. You're with us on the Budget Countdown, and we have a full house of tax experts here to decode what Budget 2025 might have in store for us, the common taxpayer, and of course the country at large, and the financial markets of the country, which is exactly what we're going to talk about now with our experts over here. So, Sameer, so many headlines happened in July, and I think the markets weren't even prepared for it. And the markets digested it really well, this 10% moving to 12.5%, right? Long-term capital gains. Are there any outstanding outlier issues on capital gains that need to be addressed?
So I would just pick one, actually. There are a few, but I'll just pick one of them. This is to do with the offer for securities, the OFS concept. When a company is going in for listing, correct? The existing shareholders, the promoters can offer those shares as part of the IPO process.
Sure.
Now, the way,
and a lot of OFS has been happening.
Absolutely.
The market's been elevated, so people have been selling.
230 public issues and all of that, and the data is all out there.
Yeah.
So I would just say that these securities, right, are otherwise treated as listed securities.
Okay.
So even though they're unlisted, they're treated as listed. And the reason is that, a full STT is collected on them.
Okay.
So as you know, when you buy and sell on the market, there's a 10 basis point either pays.
Right.
In this situation, the seller pays 20 basis point as an OFS product. So the 2-year window, which is there currently for unlisted, because this is like a listed security, they need to rationalize that and make it 1 year. I think that's a big ask from a lot of the companies which are going for IPO.
So you're saying that anyone who has been a shareholder pre-listing, right now they need to be a shareholder for 2 years to get the benefit of long-term?
For long-term, correct.
Okay. So if that can be brought down
that's
to
we rationalized and made it similar to, the existing listed 1-year term that is there.
Okay.
So that's one of the big asks that is there still.
Okay. Okay. All right. Bijal, anything from a, from an sort of investments perspective, capital market perspective that you want to see?
So I would just say two more in addition to what Sameer mentioned. One is, we've done a great job on rationalizing the capital gains tax rate for listed long-term gains. Perhaps we can have a rationalization even for short-term.
Okay.
Because we have different rates which apply for, whether it's listed, whether it's unlisted, or for that matter, whether it's any other asset.
Sure.
So perhaps that's one. The other would just be, vis-a-vis what is considered long-term and short-term, the period of holding.
Yeah.
We have a 1 year, 2 year, 3 years.
Sure.
It's just too complicated. We could perhaps just look at a simplification with just one period of holding itself.
So, Sunil, comment on this. I don't want to connect the dots because I track the stock market as well. So I know, FPIs are leaving for different reasons and not tax. But I don't know, considering how the mood in the market is, do you at all expect any thinking on the tax front to look at not just more FDI coming into India, but maybe even, make it more attractive for the FPIs that have been rushing to New York, it seems?
Absolutely. No, so, okay, Surabhi, that could be for a variety of
other reasons
as well.
Yeah.
If you ask me personally, I'm not expecting any major changes now. But yes, if you ask me whether the FPIs are actually expecting, yes, they are expecting maybe a couple of things.
Okay.
One is they really find the revised rates of tax, both for long-term and short-term, little higher.
Oh, this is the feedback that you've been getting?
Yeah, because they were used to paying, lower, tax. Also, I think, I know this is a big ask, but in my view, logical ask, because they know that historically, if you look at when the STT was introduced, the whole idea was that because long-term capital gains were exempted and short-term capital gains were taxed at a lower rate.
Okay.
Now that we have actually made long-term capital gains taxable and increase the tax rate on short-term capital gains, is there a case for removing STT?
Wow. Okay. That would be a big headline, right?
Absolutely.
But those STT collections have been growing pretty well. So
very robust.
It is, but it is still like couple of percentage of the overall tax collections. So
okay.
So I don't know whether that is something
Sameer is smiling.
We should consider. No, I know.
I think if you want to contain fiscal deficit, they're going to count every rupee. So
every rupee counts. And that too, if you have to give any sort of giveaways on the personal income tax side, then maybe you need to do your math. Okay, very quickly, we're sort of rushing through final expectations on GIFT City. Again, a stated government intent of making it a thriving international financial center. What are the outstanding issues or anything remaining that needs to be done there, Sameer?
No, so 2 or 3 quick ones. I'll just say, like you rightly said, they want to make it a global financial hub, right? So they've done a bunch of things on the banking side, non-banking side. I think 2 things resonate. One is to the earlier question around, FDI. I think if they can promote how it can become, a global holding structure, right, for companies, right? There are a lot of companies which invest in India as well, India outbound companies which have holding company structures, right? Okay. So that migration to GIFT, if that can be made tax neutral. So
right now there is a tax involved. If you're shifting that structure to GIFT.
So these are Indian company shares.
Okay.
The moment you move the holding company structure from a foreign jurisdiction to GIFT, there will be Indian tax because it's CGT. So can you give that one-time, exemption on that, just as they're given the fund industry?
Sure.
And the other is, today the banking units can issue ODIs, as it's called, on the Indian market, and there is no tax on the ODI holder.
Okay.
That needs to be extended to, the non-banking units as well.
Because there are a lot of non-banks that are setting up,
there are AIFs that are setting up,
GIFT,
absolutely. So I think that definitely needs to see the light of day.
If you want to have the whole ecosystem sort of come up.
Absolutely.
Final thoughts, ladies and gentlemen, I want to talk about this whole rationalization of the TDS and TCS rates, because I remember every year I speak to you all and we talk about how there are some 30+ rates in terms of withholding tax. What are the recommendations and how feasible is it, Sunil, to bring 30 rates down to maybe 2 or 3?
It is absolutely feasible.
Okay.
Actually, today there are 30+ provisions. Okay. 9 multiple TDS rates applicable for the payments to residents and 12 different rates of TDS for payments to non-residents.
Okay.
So, of course, you can actually bring it down to just 3 or 4 different rates. Okay. So, that's point number 1. Point number 2, I think there are a lot of these threshold limits that you have in each of these TDS, provisions, starting from as low as rupees 5,000. I think that needs to significantly go up.
Okay.
And I think there are a lot of other terms and conditions.
Sure.
So this whole thing is making very confusing and complicated. So I think there is a big opportunity for government to actually rationalize the TDS provisions.
TDS, capital gains is done, maybe TDS should be the next one.
Yeah.
Final word, Sameer, what will the headline be? Again, the same question I asked Bijal. What will the headline, you think, be on the 1st of February by the evening when we're done with the budget? Tax headline.
I think it would say, tax simplification 2.0. I think something like that.
Lovely. That would be, I think, very well received by the entire fraternity. Thank you very much, all three of you, for coming in here and helping us sort of make sense of the broad budget expectations and the roadmap that the industry is looking forward to. Thanks for joining.
Thank you for having us.
Thank you.
Well, that's it. It's a wrap on this special edition of Budget Countdown. We'll see you again with more conversations in the course of the next few days.